And welcoming you to our session on farm credit, ground truthing the beginning farmer experience with credit. Just had a really nice conversation with a number of our speakers. And whoops, let me try and take care of that. Why don't you go ahead, Gary?
All right, I will do that. Thanks, Jeff. I'm Gary Matteson of the Farm Credit Council. I work for the Trade Association of the Farm Credit System, the Farm Credit Council in Washington, D.C. as the Senior Vice President for Beginning Farmer Programs and Outreach. And I have with me today some lenders from around the Farm Credit System who you'll meet in just a few minutes. Raechel Sattazahn from AgChoice Farm Credit, Samantha Stoddard from Farm Credit East, and Terry Hinds from Compeer Financial in Illinois. So I'd like to welcome you to Ground Truthing the Beginning Farmer Experience with Credit. The goal of this session is to understand beginning farmers, their credit needs, their appropriate use of credit and credit enhancements, their different business models, and their likely career paths. Our strategy is to look at beginning farmer data from the Ag Census through a business-minded lens by applying a market segmentation approach. In other words, we're going to identify different segments of the total beginning farmer market to show the diversity of beginning farmers as individuals and as farm business operations. Our panelists are all seasoned lenders who work with beginning farmers. Their real-world experience is what will ground truth the abstract statistics from the Ag Census. Next slide, please. So before we dive into cool maps and charts and graphs, I have to note one big change from the 2012 to the 2017 Ag Census. That is the elimination of the principal operator framework. The implication is that there will be no way to directly measure who is in charge of a farm operation. Instead, what will be recorded in the Ag Census are members of the management team, which may include a younger beginning farmer. Next slide, please. This is a map of farms reporting a beginning farmer in the management team. Let's call those operations a beginning farm. I suppose you could say that the darker the green on this map, the more fertile the ground is for beginning farmers. The darkest green showing that there are more than 300 beginning farms in that particular county. For those of you who are worried about having enough beginning farmers, I can assure you the pipeline is full, with almost 30% of all farms having a beginning farmer in the management team. Next slide, please. But we have to discount that happy news by noting that not all beginning farmers are young. New entrants to farming may have accumulated a significant number of birthdays. You have to admire the optimism of a beginning farmer who is age 75 and older. Remember, a beginning farmer is defined as a person with 10 years or fewer in a management role. So one reason for older beginning farmers is the trend for farm ownership transitions occurring later in the life of the older generation. For example, a son or daughter leaves the farm after college for a career in agribusiness, then returns to the farm management team as an early retirement strategy from their non-farming career at age 40. That makes them a beginning farmer. Next slide. In trying to figure out on what sort of farm we are likely to find a beginning farmer, we can see that we are more likely to find them on farms with more than one operator on the management team. That's not to say that most beginning farmers are on large farms. As we'll see in another slide, by number, there are more beginning farmers on small farms, but by frequency, multi-operator farms are more likely to have a beginning operator. Next slide, please. So going back to the 2012 Ag Census data to be able to compare principal operators to junior operators. Okay, another term, a junior operator is on the management team, but not the boss. Okay, so we're going to compare principal operators with junior operators from the 2012 census. We find that beginning farmers are more likely to be on farms with larger sales. That's kind of what we would expect. A larger farm business is more likely to have the next generation on the management team. And there's more room for more employees on a larger farm too. So now that we've looked at where we are likely to find a beginning farmer, let's look at some background information to be able to understand market segmentation. Next slide, please. The vertical green line in this slide marks $250,000 in farm sales. noting that Farm Credit's definition of a small farm is a farm with less than $250,000 in total sales. You can see that 88% of all farms in the Ag Census are small. So here we have one way to segment the market of all farms. The dark green showing all farms in the sales category, and the light green showing operations with farm business debt. You can see why Farm Credit wants to know this sort of information. The farms with debt are potential customers. You can see that in general, the larger the farm, the more likely that operation is to have farm business debt. As a way of understanding Farm Credit's business, 76% of Farm Credit loans are for $250,000 or less. Roughly 50% of Farm Credit loans in our portfolio are for $50,000 or less. Next slide, please. Another way to segment the market for all farms is by acreage size. Again, for Farm Credit's purposes, we're looking at total farms of a given size and farms with debt. As you'd expect, the largest farms by acreage are the most likely to have debt. By the way, Farm Credit has about a 40% market share of farm business debt, about the same as commercial banks. Next slide, please. Comparing all farms to beginning farms by sales size, and remember, a beginning farm is an operation that has a beginning farmer on the management team or is a sole operator who's a beginning farmer. So we can see that, like all farms, most beginning farms are small. Again, this preponderance of small beginning farms is due to sole operators on the smallest farm sizes. Next slide. Like the previous slide, we're using farm sales size as the basis for segmenting the market of all farms into three categories of farm business expectations. And by farm business expectations, we mean, what does the owner operator of that farm expect to get out of their farm? So these are the three categories: part-time hobby farm, intermediate income generator farm, and commercial ag production. And those describe what the farm business operator expects the enterprise to contribute to family income. These market segments are based on the available data from the Ag Census and are intended as a theoretical model with which to understand what beginning farmers in particular want and need in the way of credit. So I'll be asking our panelists questions based on these three market segments so as to see the different needs and services that beginning farmers have. So let's go to our panel. And my first question is for Raechel. Raechel, using farm business expectations as a market segmentation model, how would you describe a typical commercial farm business in AgChoice Farm Credit Services area, and what are their credit needs?
Sure. Well, good afternoon, everyone. And yeah, when we talk about commercial ag or commercial farm businesses within AgChoice's territory, so AgChoice Farm Credit, we cover most of the state of Pennsylvania and very diverse territory that we do cover. But when we're talking about that, we're mostly, saying that that farm business is really deriving all or a vast majority of their income from that farm business, and really so that scale of that farm supports probably multiple family members. So I'll use myself as an example in this. So my husband and I and his family, we actually have a dairy farm here in Pennsylvania. And, my husband, obviously I work for Farm Credit, but my husband's on that full time along with his brother. So certainly our, dairy farm there is a commercial size business supporting multiple family members. And so when we're looking at like credit needs for a commercial operation, so whether it's a dairy farm like mine, maybe a large crop farm in our territory, or, a nursery greenhouse, or what have you, whatever sector of agriculture they might be in, there's a few different credit area needs that likely, those commercial operators might have. One that a lot of people normally think of is the land, right? Yeah, if you farm, you need lands. And so people often think of real estate, and that's certainly important, but that's not the only credit need that a farmer might have. have. Certainly equipment would be another piece of that, equipment to do the job. Operating needs. So, oftentimes we talk about it, that in a sense of a credit line of some sort. So how can we fund their operating needs? Building projects. So on our farm, we built a new barn, a couple years ago. So building projects, facility improvements, livestock purchases, cows to fill that barn. So really for a commercial farm operation, lots of different credit needs. Not that some of these needs aren't the same for those intermediate or the part-time farms, because certainly they do flow through, but likely maybe that commercial farm operation has a few more of these needs all at one time, I'll say. So that's a little bit about commercial farm operations and how we handle that here at AgChoice Farm Credit.
Excellent. Thanks, Raechel. Hey, Terry, I know that Corn Belt row crop farms are often treated as the mainstream standard for a farm business model in Compeer's territory. Going back to the market segmentation concept of farm business expectations, how would you describe the typical intermediate income generator farm in Compeer Financial's region?
Thank you, Gary, and welcome everyone. As Gary mentioned, we're in the upper Midwest, Illinois, Wisconsin, and Minnesota. And when we look at that segment, we're really looking at the buying attributes of the client. And so we see a group of farmers that may be not growing their business very much and in a position of transitioning out of the business. And many times there will be family members that want to come in and participate in the farming operation as mom and dad near retirement. And so think of dairy farm in Wisconsin. The families had the farm for many generations, and son or daughter have left. They come back to the farm. It's not commercially large, but it's still viable, and there will be a gradual change. But so we see that one segment. We, however, see another very, very interesting segment that's starting to crop up. And those are individuals that are educated, and they've gone off and done something very creative with their lives. The husband and wife have probably not even been in the upper Midwest. They've moved around the United States, had a career, and they've opted to come back and start from fresh. And when they start from fresh, they're really looking at value-added types of operations. They're not looking at straight commodities. So they might be back in Wisconsin doing dairy, but they will be doing specialty dairy, or they would be doing specialty beef. They would be selling directly to Chicago or Minneapolis, aligning with restaurants and that sort of thing. Very creative. And the skill sets that they bring are quite different than the agronomy skill sets that the first group might have. They're really more focused in the business plan, and the strategy around how they want to go about driving their business. They're very growth oriented. And want to grow their business rapidly because that's what they've done in their prior experiences. Very, very interesting segmentation. We need to approach those two client sets quite differently. Probably the latter will grow and be wildly successful, or they will fail rapidly. And if they fail rapidly, they're pretty buoyant. They will probably spring off and go do something else. The first group that are going into the traditional operation will need to be looking at off-farm employment unless they grow their operation. So that's kind of how we look at it, Gary. It's quite interesting, and beginning farmers are coming in, as you mentioned, not so much when they're 18, but maybe when they're 48 or they're 38, or they're even, you mentioned, 68 kind of thing. But there's a lot of energy and a lot of thinking that's going on there to create a whole new scenario. Thank you.
Great. Hey, Samantha, Farm Credit East Territory includes New Hampshire, where we both live. And full disclosure to everybody out there, I've been a Farm Credit East customer for nearly 30 years. So, Samantha, what are the characteristics of a typical part-time farm operation in the Northeast, and what are their credit needs? Ooh, we can't hear you, Samantha.
Sorry about that. I forgot about the mute button. So Farm Credit East does serve the Northeast. That's New York, New Jersey, and New England. And a lot of our farmers are part-time. What we see with our part-time farmers is that they have very specific needs. related to generally purchasing of equipment, whether that's a tractor or a hay implement because they like to produce hay on their weekend time, or it's a maple producer who needs to have an RO, an evaporator or steam away equipment. And these pieces of equipment generally are under $25,000 in this area. And so they're looking for a term credit generally for that specific piece of equipment. Many of the part-time farmers that we work with are also have off-farm jobs, either both partners in an operation or one partner is the farmer and the other person has an off-farm job. And so they are very much part-time. They might, as I said, have maple operations, or they might grow some chickens and sell their eggs to their neighbors. But we also have part-time farmers who in most circumstances would qualify as full-time farmers in some cases. I'm thinking of specifically one of my customers, it's a married couple, one's an attorney, one's in IT, but they operate a very successful pick your own apple operation that generates sales of over $800,000 during the fall season. So by most circumstances, they're full-time farmers, but they're just part-time farmers because their primary income source is that off-farm job. And they still need equipment to buy wind machines. They still need equipment to put up deer fencing. And so we are able to provide that for them.
Well, $800,000 is a whole lot of part-time. Wow. So I know you have a slide.
Gary, this is Terry.
Yeah.
I'm just a little worried you haven't paid your loan off in 30 years. So as a lender, that's kind of a red flag, but we'll leave that for another conversation.
Thank you, Terry. I appreciate that. Yeah, I don't need to hold up my personal financials here. Samantha, I know you have a slide ready about this. Could you tell us about the breadth of agricultural enterprises that Farm Credit East lends to, and maybe include a quick example of a typical commercial ag operation and intermediate income generator operation?
Certainly. As you can see from the slide, the industries we serve, the largest by far is dairy, representing almost a quarter of our operation. And a lot of that dairy is located in Western New York. But also in Maine. And then we have a wide selection of other opportunities, greenhouses, livestock, which can include beef operations that many of you may be familiar with, but it also includes equine operations. And in my portfolio, it includes bees. I have several bee customers with thousands of hives, and so that falls right into that livestock area. In Cache Field, that's where a lot of our hay farmers are located. They are generally part-time farmers. One that I'm thinking of in particular is a lineman for an electric company, but he grows a little bit of beef and he does hay in the summertime. So for an example of a commercial ag operation, one of my farmers is mainly a fruit farm. They have pick your own fruit, apples, peaches, etc. But they also have a very large vegetable operation where they sell those vegetables to the Hannaford supermarkets, up to 31 stores this year. But they have also diversified their business, and they have a farm supply business as well, which includes a lot of irrigation equipment. And we had a drought in the Northeast this year. And so that segment of the business doubled in size this year because so many farmers needed to get some irrigation equipment so that they could maintain their own sales. So we look for businesses that are traditional, as you can see by this graph, but we also look for those businesses that help our farmers in some way. We would call them farm-related businesses or farm services, such as farriers or large animal veterinarians.
Excellent. Thanks for that description with examples. And Raechel, likewise, could you show us AgChoice Farm Credit's portfolio and a quick example of part-time and commercial ag operation there?
Sure. Well, not surprising, at AgChoice in Pennsylvania region, we're kind of similar to what Samantha showed there for Farm Credit East, although we, in our loan portfolio, as you can see on the slide there, parse out those part-time farms. So we actually say part-time farms is about 25% of our total portfolio. So very, very significant. Certainly a lot of part-time farms in our neck of the woods. And so when I'm talking about part-time farms, it's exactly what, Samantha and Terry were sharing. It's someone someone that's got an off-farm job, but maybe they have some beef cows, maybe they have some, crop acres, maybe they have a chicken house, but they still maintain that off-farm job. And so that's about 25% of our portfolio. Dairy is also very heavy here in Pennsylvania. Forest products, that's why Pennsylvania is called what it is, right? We have lots of trees here, and that's certainly important. And I would say we're very diverse. We cover a lot of other different, commodity areas. And so when I think of different types of commercial agro operations, as I look through this, obviously a commercial dairy operation, like I shared, forest products, a lot of times they have larger operations that are commercial in size. From a crop farm perspective, maybe it's a crop farm with lots of acres and maybe they do some, custom work on the side. I think in general, with a lot of farm operations, diversification is an interest area. And sometimes that's with the next generation coming on board. So you see, these opportunities of, diversification. Greenhouses, orchards, farm markets, and all those are what we would consider, commercial operations. I also did pull out just a quick statistic there on our beginning farm loans within our territory. So of all of our loans within AgChoice, over 25%, so over a quarter of them are actually made to beginning farmers. And back to Gary's definition, that's 10 years or less in farming. So very significant portion of our portfolio. And I would say that's probably true across the farm credit system.
Yep, that statistic is pretty close to the national average for farm credit, Raechel. It's just I think it might be 27%, something like that. So Terry, most of us don't expect there to be small part-time farm businesses in the area of the Corn Belt that Compeer serves. But can you give us an example of that kind of operation, a small part-time operation with a general description of the size and scope of a typical commercial ag operation? A lot of us aren't familiar with the big numbers that you can get to in a commercial ag operation. And please tell us what you see as new situations or pressures on ag businesses and farmland.
Sure, Gary. And the slide that I have up is a very interesting slide, particularly since we're talking about beginning farmers. On the left is our portfolio, and as Gary pointed out, cash grain is really significant in our territory, and the operations are large, $1 million type revenues by many farmers, and about a third of the portfolio is that way. Interestingly, we have just practically the same percentage of our beginning farmers are cash grain operators. So they are able to slide right into those operations, but their scale will be much less. And so by that, I'm saying that they will be able to rent property, particularly in the upper Midwest. There's a lot of absentee land ownership. Folks like myself or Gary left the farm, but we've saved money. We've invested in farmland back, in our home area, or we've been gifted land from estates, et cetera, and we tend to hold it. And so then you find absentee land owners are looking for interesting folks to farm their property, and many of the young or beginning farmers are really the kinds of individuals that they want to have on the operation. So we see a lot of that occurring. In the dairy and cattle arena, it's somewhat similar. And as I spoke earlier, in the dairy arena, they can be quite large, just as they are in Pennsylvania and in New York. We have thousands of cows, or they can be very specially and small. And we're seeing the beginning farmers coming in and doing small herds as well, doing specialty kind of product. The example I wanted to share was really about a beef farm operation, and it's led by a female. She's an Ohio lady, grew up in Ohio, went to Ohio State, got an MBA at Ohio State, was very active in a business career. Her husband was in genetics, worked for a genetics company in the beef industry, and they were moved to the upper Midwest. And when they moved to the upper Midwest, they decided that was the time for them to start their operation. They actually went in and rented some farmland, about 50 acres from an absentee landowner, and they started a very small scale operation with cattle. But the graduate from OSU with the MBA, the female entrepreneurial lead, leveraged technology substantially, media technology, connected with folks in Matteson, folks in Chicago and Minneapolis, and actually barnstormed, if you will, their product. And when they launched their first product sale of specialty beefs, they sold out in less than 4 hours. They were then, she's a savvy business lady. She leveraged other producers in the marketplace so she could fill her line. She started borrowing a little money, got some grant funds, and eventually got a herd going at a much more rapid pace than what you would normally see in a commercial operation, because she had demand for a product. And so she spends all of her time doing media, doing connectivity with consumers, working firsthand with restaurants or individuals that want their beef product. And they have grown very, very rapidly. We're seeing their sales increase 100% on an annual basis the last 4 years. They're in the $300,000 to $400,000 range in sales now. Their goal is to run their operation from scratch and not have to do off-farm work. The husband is still working off-farm, so that's how they're sustaining their family living. But their operation is starting to scale rapidly enough that they're able to do that. They have purchased a farm now, the 50 acres that they rented, they purchased. And they continue to really solve their problem looking at the consumer and the demand side instead of the consumer side. Interestingly, and we had confidential interviews with these individuals to see how they're thinking. They are not connected with any of the traditional co-ops or farm bureaus or any of the traditional agencies that we would think that's normal in the marketplace. They are working with folks in the cities on new thought or marketing or sales. And so they are not looking for the support that the traditional farmers have. And we find that very interesting and actually is quite challenging for some of the mainstay ag industry support folks, that they have to find a way to connect to these new thinkers, if you will. They are interested and work with Compeer, and that's because we do have a focus on working with farmers in Chicago. Yes, there are farmers in Chicago. We have beef farms in Minnesota, in Minneapolis, St. Paul. So, we look at some of those areas, but the difficulty is finding the clients and finding Compeer. So I think there's a renaissance going on and a demand for new energy and new thinking and new strategy that many of these beginning farmers are bringing to the marketplace, which is quite exciting.
Great, thank you, Terry. Raechel, one of the things that I've read about in the paper lately is and I've seen among people buying homes here in my part of New Hampshire, I'm 70 miles away from Boston, is that flight from the city phenomenon of people who are able to move either to their summer home or buy a new home because they don't want to be where there is a higher risk from COVID. Are you seeing that sort of thing in AgChoice's territory?
Yeah, definitely. And I it's something we've seen probably over the last several years. But boy, this year with COVID, just really put an exclamation point on it. We have so much increased interest in people getting away from more urban, suburban areas and getting out in the country, either buying land, buying country homes. They may or may not want to farm at this time, and maybe they have a future dream of farming, right? But yeah, there is a tremendous wave of folks, moving from more of the urban areas to the country. And our requests that we're receiving through our website and loan requests are just through the roof when we're talking, especially about country homes and land.
So Sam, I see you nodding your head. Same thing happening here in Farm Credit East territory?
Absolutely. I was talking with one of our consumer loan officers, and he was telling me that when you're telling people what the estimated closing time will be for a country home loan, he says they were 75 days out, sometimes pushing 90 days closing because the appraisers are backed up and the title companies are backed up. So there's just been a tremendous amount of people interested in buying rural homes, and that can be a house with large acreage. I was talking to one of my appraiser colleagues in Maine, and he was saying that people are buying just vacant timber lots in Maine because eventually they feel like they will move to that area, and if they don't, the value of that land will not go down. So they see it as a good investment, particularly where other investments are a little bit uncertain right now. And so we are seeing just a tremendous amount of loan volume. We've seen horse farms that are on the market for a weekend and get full price offers. And so that is very good for those who are moving out. And, you know, hopefully the ones who are moving in can continue to operate successfully.
Great. Well, Samantha, going back to your first example of a typical part-time operation, what is that beginning farmer facing in terms of business risk, and how do they handle the risk? What does that kind of beginning farmer usually have all the capital that they need because it's a small operation that they're starting?
Usually they do not. So a lot of our part-time farmers or part-time beginning farmers are in the early stages of expansion, I'll say, particularly in the maple industry. So we've had a number of customers who come to us because they've been operating for a couple of years with very small evaporator systems and decided that, you know, they want to make this a really good part-time business. And maple is ideal for that because it is such a short season. You tap your trees in January and February and the season's done by the middle of April. And so it's very conducive to having an off-farm job for most people. And when they come to us, they don't often they do not need operating expenses, and they do not need real estate money because either they own the land already or they have handshake agreements with other landowners. What they are looking for is capital for equipment. And so they are looking for a small amount of money, $5,000, $10,000, $20,000 to buy that equipment. And it's too much to put on a credit card. But so they're trying to figure out, okay, how can I get this financed? And when we look at that, we try hard to figure out how can we do that, because our farm credit organization, and I'm sure other ones do too, have a down payment requirement that's usually about 20%. So if you're buying a $20,000 piece of equipment, your down payment's $4,000, and that is sometimes a hurdle, sometimes that's not a problem. And so that's where we have to try to get creative sometimes with our part-time farmers.
So Raechel, how much of their net worth is a beginning farmer betting on when they start up a commercial scale ag business? And where does that money come from? And are there risk mitigation tools available for the farmer and the lender in those situations?
Yeah, so for a brand new beginning farmer to get started in a commercial ag operation, it will be extremely hard. You know, we often most see, how does that commercial, ag business transfer? Oftentimes, maybe they have an existing family member in the business, and that's how they're, building equity and getting started there. You know, we've had a number of success stories within the state of Pennsylvania of, maybe there's an older farmer wants to get out in the future, and a new farmer in the area wants to get started, and somehow they link up and are able to forge a relationship, and that transition happens. So the actual I have a dream of farming and I want to do it on a commercial size is a little bit hard to get to, right? And so normally what we see with beginning farmers is they normally start small, right? And that business might grow. And I'm not saying it won't grow to a commercial size business, because it certainly can, but it takes a little bit of time to get there. And in the meantime, that's where, maybe it starts off as a part-time endeavor, and they have their off-farm income that's helping, putting some of their personal finances into getting this business started. And frankly, as a farm credit, organization, them starting a business like that and having some of that off-farm income is a bit of a risk mitigant, right? We know that it's not all being bet on by whatever small farm business they're trying to start. And so really having that off-farm income as a beginning farmer get started is actually sometimes a good thing. And that's sort of a good progression. Again, to dive right into a commercial operation, it's probably happening in one of those other ways. But certainly we have seen some some of these, beginning farmers, they get started and the business can take off. It really can. And so there is some great opportunity there too.
So Terry, your turn. How much of their net worth is a commercial ag beginning farmer putting on the line? And where does the money typically come from? And what risk mitigation tools are available in that situation?
Sure. I'm going to be an economist on this one because it depends. The individual who is connected to a very successful family that's moving into the beginning to manage that operation and lead that operation probably has a pretty solid parachute. Because the families have deep pockets. There's substantial wealth in the legacy business, and I would say that their biggest risk is really family risk and strategy risk. And the family risk is about, are we really committed to the family goal and vision, and is it what we want to do, and are we strategically aligned? Because during the transition period, it's important for the folks that are removing themselves from the operation and the new thinkers to be aligned until there's a successful handoff. And sometimes those can be actually more challenging. The personnel and personality debates can be more critical than financial. And so I don't want to ignore. We don't want to ignore that. And we do some counseling there. And we actually work with some outside firms on preparing transfer of that commercial business to the new operator so that they can think through some of those items. Now, the individual that, as I described before, that's coming into an operation from the outside with business wealth, or with the ability to generate strong earnings, are betting the house generally, because they want to scale their operation very quickly, and so you're putting it all on the line. I would not say it's a bad risk, because in most cases they're very robust in their business planning, they're very robust in risk management tools, and very sophisticated in how they go about attaching those tools. So they will apply options through the board of the mercantile exchange, and they will protect both inputs and outputs, and they will leverage the opportunities that are available there. They'll be very sophisticated in their pricing and packaging and risk management on utilizing the board. They will also utilize a wide variety of crop insurance tools that are available to put a downside risk in play. And there's also livestock risk management tools that are available from the federal government that they will utilize in order to have some stop gaps, if you will. They'll have very strategic and very robust marketing plans, and or fallback positions with buyers that are robust, that are actually as sophisticated as you might see with some of the large, very, very, very large meat companies that might have with Walmart or the Costco's. The folks will have very deep relationships, so they have protection on what their products are going to end up at and where they're going to go. They will do benchmarking, and will do a lot of peer analysis and learn from the marketplace. And so we do benchmarking at Compeer. I know that two companies, both AgChoice and Farm Credit East do as well. We think that's really important for them to see how they match up. But what we're finding is the beginning farmers look at non-farming businesses for benchmarking as well. And there's so much information available in the broad market through Bloomberg and others, that they can start to match up and find operations in Texas or California or Florida that would match with Upper Midwest, et cetera, because some of those are nearing public or there's enough public information that you can start to benchmark against those. And then we find that they do diversification of operations, and they do that through, we've talked about it, they might have revenue being generated from a salary. They might have livestock contracts that are embedded in a variety of places so that there's premium on the cutouts that they have, or they might have premiums on the products that they're providing, or they'll have specialty corns or specialty, any kind of specialty that's unique. They will actually start to vertically integrate. Most of the commodity farmers didn't bother to integrate at all. They produce the commodity and let the integration happen by agribusiness. We're finding the new beginning farmers are integrating and going up channel much more quickly because there's more value proposition there. That also provides them some risk mitigants. And finally, they run the farming operation like a startup venture capitalist kind of mindset. And that's different than just being a productionist. They might be very good productionists, but they've added this additional sophisticated business leverage on top of the operation. It really makes it robust and strong, and not fail-proof or bulletproof, but it does provide risk protection. So they do those kind of things. And then finally, when they borrow money very smartly. So they might borrow money, some of it will be on a variable, very short term, and then they'll layer in a variety of fixed rates so that they have their cost on capital even protected. And then last and not least, they are not at all afraid to tap into the equity markets if they need it in order for protection as well. So they might have a balloon there for some kind of protection. So Gary, great question. We're seeing a significant amount of sophistication in this arena, and it allows the business to have oxygen when it's wanting to grow. And it really allows lenders to be relatively comfortable in the ability to make a loan into some of these more sophisticated operations.
Excellent. Well, during this conference, Samantha, we've heard a lot about how to get credit and barriers to credit and credit enhancements. And building on what Terry was just saying about borrowing smart in creative sources of credit, I think it would be helpful to take a step backwards and get an explanation from you on what are the right things to borrow money for, and that as a basic credit skill that beginning farmers need to have.
There are two general areas that you should consider borrowing money for, and those are things that can make you money or things that can save you money. And so an example of things that can save you money, if you're reviewing your profit and loss statement and see that you are spending a lot of money on repairs, maybe you need to buy a new thing, whether it's a tractor or something else that is causing those repairs. Another example is if you determine that you're spending a lot of money on rent, you may decide that it's worth it to purchase your facility or a different facility because you'll be spending the same amount on your debt service that you're spending on rent. So we're looking at what can save you money. And the other half of that coin is what can make you money. And so if you can make money by buying a new implement that saves you labor costs, that both is going to save you money, as we were previously saying, but it can also allow you to do more with the same amount of labor, and therefore you can make more things, produce more crops, and then make more money. So those are the two basic criteria that we have when somebody asks us for a loan. How are you going to save money, or how are you going to make money? And that is true for equipment, for real estate purchases, or even an operating loan where you need to purchase a lot of either fuel for a greenhouse operation or labor for many operations. How will that save you money or make you money in the future?
Now, Raechel, are there situations where a beginning farmer is actually going to have no debt at all? And I realize that you're in Pennsylvania and there may actually be that proverbial oil well in the backyard, but what are situations where a beginning farmer is not going to have debt?
Yeah, so I'd say maybe to this, I really feel it probably depends on the operation, the scale of the operation, its needs. Some of the small part-time farms, maybe they don't need debt. Maybe they can sort of self-fund, the new tractor they want to purchase, or or what have you. But I really love Samantha's discussion there about what makes you money or saves you money. And I think for operations to grow, right, that's where, debt can really be a great tool of helping them make more money or save more money, right? So I think it gets harder and harder as your business probably grows. And so that's where I'd go with that question.
So Terry, you've had I won't say how long a career, an extended career with Farm Credit, and I know you've heard the phrase people complaining about access to credit. What do you think of? What's your response when you hear people complain about access to credit?
Well, first of all, that's probably true from their perspective, but they're not probably looking under the right rock, because particularly the last 3 or 4 years, there's so much capital available today for good ideas. As lenders, when we hear that, we ask the client to sit down and visit with us, or if we're doing it electronically, to describe who and where they're looking, because there's money available in a wide variety of areas. It's really a function of price. And so if you want to have, if you really are not financially viable, if you really don't have a very strong financial statement, but you have an absolutely brilliant strategy for doing something in the marketplace on the marketing side, then we need to get that individual to someone that would have probably a higher rate of interest, on the equity side, maybe a Ribic or something. And then when that idea explodes and is very successful, they'll have all kinds of other traditional lenders that will be available, but there are startup dollars available for really, really, really great ideas. If the beginning farmer has some access to funding, but they're not aware of the farm credit system, or they're not aware of the USDA farm FSA markets, or SBA, we try to help educate them on what's available in the marketplace. But from our perspective, and from everything that we've seen the last 3 years particularly, there is a ample supply of capital available. You just need to help them to look. And so our counseling there is to match them up with what they're trying to do and what their financial statements look like and what their probability of repayment is, and then help them to get connected with those particular individuals. We find it, and we've helped a lot of clients that do not borrow from us on day one. They will go to a different lender at the beginning, but they will come back and work with Farm Credit, in year 2 or year 3, if it was a little bit too risky, but they had a brilliant idea. Or at other times, we'll work with them directly, when they're trying to get started. So my advice is nose around, find a smart lender, and start asking questions, because there's ample capital available in the ag space. It's a hot market right now.
Great, that's good to hear. Raechel, can you walk us through the mechanics of credit delivery from the lender side? Tell us what's happening inside a Farm Credit Association that a beginning farmer doesn't know about.
Yeah, so I would say to that, Farm Credit, and really I would say most lending organizations really are trying to make decisions for the best interest of the borrower. Really, the borrower-lender relationship, it's very much a two-way street. And from the lender's perspectives, we would love to fund everyone's hopes and dreams, but we don't want to put anyone in a bad situation either, right? And so that's where a strong business plan comes really into play, especially for beginning farmers, or even existing farmers trying to do something new. Really understanding what they want, how it's going to be, how they see the numbers playing out. An important piece of a business plan is budget and the projections as well. And so taking the time to do that is really important and can really build a great rapport with whoever the lender is that you might be working with. Now, from a farm credit standpoint, you know, every farm credit association is a little bit different, but, you know, in general, I'd say a lot of times, a lot of smaller loans, we take a little bit more of a scored approach. And it's almost where sort of how if you'd go into a car dealership and, you know, and get financing, you know, right then and there pretty quick, they're pretty much pulling it off your credit score, right? So it's similar type of concept when you're working with farm credit associations, especially for a lot of our smaller type loans. So I know we do a lot of educational efforts here to AgChoice of personal finance for folks, you know, even youngsters, like, hey, this is really important. Understanding what a credit score is, you know, how to improve it, like all of the things, right? Because it is really important. And again, not just for farm credit, I would say, but probably even a lot of other lenders, credit score is really important. And for all loans, but especially when it's a small loan and we're probably not doing a whole lot of other analysis beyond that, right? As you get into more like commercial sized loans, you know, for, you know, big real estate purchase or big building project or, you know, what have you, a lot of times we'll do more of a trended analysis on that. So we're actually sort of projecting what that income is going to be. So, okay, you want to build you know, another barn to your facility, you know, what does that look like from you know, your income side, and does it make sense for you to build that barn essentially, right? So we put a lot of effort in that. And again, all of it really goes back to the bottom line of it's a two-way street. And, you know, we as a lender, we don't want to put borrowers in compromising situations either, but we do want to see their, you know, their dreams come true as well. So it's a little bit of a balancing act there, but a little bit of a change too on size of loan and other considerations. But personal finance is really important, and have a good credit score no matter what.
You know, I thank you for getting us on the topic of education, because that's what you were saying. That relationship with the borrower is frequently about education. Even the sophisticated borrower needs your help to understand, should I really build the barn or not? Is it gonna pay for itself? And Samantha, I think Farm Credit East is unique in having a specific element of our mission as serving the needs of beginning farmers with sound and constructive credit and other related services. Can you give us a few examples from Farm Credit East of programs for beginning farmers?
Yes, Gary. One of our more unique offerings is called the Farm Start program, and that is designed for people who have good ideas, who have not bad credit. So it means that they should have a credit score of 660 or better, or no credit at all. Some of our customers have no credit scores. Have 1 to 3 years of experience so that we know they understand what they're getting themselves into. And this program is for 5 years. It's $75,000 maximum. And we work with the customer to understand how they can grow their business, looking at different things about employee retention, looking at the different program or production, the economies for their production, to make sure that they understand what is making them money and what is not making them money. So this is a 5-year program, comes with one-on-one or group setting coaching so that people can figure out how to make money at their business and how to do it efficiently. And we have serviced over 300 people through this program over the last 15 years. And some of them have become farm credit borrowers and are among our strongest borrowers. And some of them have decided that farming isn't for them. And this is a kind of a low cost way for them to make that discovery. One of the people in this program once told me that education is expensive, whether you go to college or you start your own business. And so we're trying to make it, this education, you know, still takes their time and effort and some of their money, but we want it to make sure, we want that educational opportunity for them to make it for something that they can use in the future and succeed at.
Well, Terry, I'm going to ask you to do the same thing, some examples of what Compeer does for beginning farmers. But first, I'd like you to describe how you communicate through a large organization like Compeer that sense of mission that's needed to serve beginning farmers.
Well, Thank you, Gary. Sharing our mission and vision with our team members is first and foremost, and something that we do on an ongoing basis. Practically every communication that we have ties back to our purpose and the why for what we're doing. And beginning farmers is really, I mean, it's really about planting a new client into our business. And so since we serve agriculture, that story is very easy to connect. The client, most of our clients, once they are with us, they're probably going to be lifetime clients, or the majority of them will be. So it is a very, very a celebratory kind of activity when a new beginning farmer joins the Compeer family, and it is celebrated throughout the board. We have a special board committee on beginning farmers. We have teams of team members that work with the beginning farmers, and there's a pretty significant celebration that occurs when they launch their operation. We highlight many of their stories in our internal magazine and our online presence with Facebook and other kind of social media. And so we really try to leverage their story both locally and throughout the Compeer territory, much more so than we do some of the large-scale operations, because it's really inspirational. And our team members find it inspirational, and it's certainly very, very good for the marketplace. Gary, we also do outreach, just as the other two companies do, and education, because we think that's so vitally important. And we have a program we call Groundbreakers, and it's really for our beginning farmers. And last year we had over 480 attendees at the Groundbreakers event. These are all beginning type individuals that are trying to do startups. We have a lot of education that takes place during those sessions. There's a lot of sharing. So the various entrepreneurs are coming together and they're sharing their ideas, they're sharing their perspectives so that you can scale and you can take best practice from around the peer group on new startups. We also have advisory groups that are set up with that operation so that they can work in small groups of individuals that are not competing directly and share their ideas very robustly. So we think that's incredibly important. And then we lay out some additional support over a longer period of time, not just at that session, so that folks that want to know more about how to do a successful business plan, or someone that's doing very effective negotiation with a large food company, they start sharing that information so these folks can get off and running. And we do have a grant program that helps the beginning farmers at times, and so we'll grant money. And then our lending programs are quite different than our traditional programs. We do substantial discounts on loans for beginning farmers. Today an operating loan that you were talking about, Samantha, you were talking about equipment, we would automatically reduce the rate by 75 basis points compared to what our rack rate is. And when you're only at 3 or 3.5%, that's a pretty high percentage reduction. Help folks to get going. Same thing on real estate. And, we just find that those are very, very important. And then we'll relax underwriting if this beginning farmer has a really strong business proposition and marketing plan. We will relax underwriting for their business to help them to get started. And we'll actually, Compeer's making a bet. We're making a bet on the energy and the passion and the knowledge and actually the skill set of that beginning farmer, and seeing if they have an opportunity. So we'll do some of that, and that's part of the fun of being a larger financial institution. You can make some of those bets, and if they don't work out, it's actually sad, but the vast majority of them do. Thank you for the question, Gary. It's really important, and we share those stories continually with our team members And so they're very connected with those local operations.
Yeah. Well, Terry, in the list of questions from those who are on this conference or in this conference with us, I see a question about outreach to historically underserved groups. And I know that your emerging markets program was created kind of with that in mind. Could you give us a quick
Sure, and we're very open
description
to
of that kind of outreach?
Sure, we very much want to help with outreach. So in our territory, there's a considerable number of Hispanics. They're with the swine operations, they're with dairy operations, and many of those individuals are very rich traditional agrarians, and so we have special programs with them. We have special programs with the Hmong community that have moved into the upper Midwest, where we'll work with them for their operations, and they're quite unique, easier access. They might not even have credit bureaus, as someone mentioned, and we'll go in and make those loans based upon the community. We work with Amish. I would assume you have the same in Pennsylvania, where in New York, and we have active programs there. And in those scenarios, again, they probably don't even have access electronically, so we're still doing some things in paper or hand deliver, and that's okay because they're niching out, and we'll try to connect them with folks so that they can sell their specialties, their organics and other kind of products, directly, and actually create premiums. And so we find that we're doing a lot of positive things there in the marketplace. Could we do more? Yes, but we've got team members that are committed to doing it, and we're focused on us. And in fact, yesterday I had an update from that group at an executive level on the amount of energy, and we continue to see a lot of growth. We're also growing inside of the city propers in Milwaukee and Chicago and Minneapolis and and Matteson and some of the other mid-sized cities where there's actually, I call it growing agriculture from the inside out. Chicago was a great agrarian city at one time. There were more dairy cows there than there was in the world, kind of thing. I'm being facetious, but there were a lot that she knocked over the lantern, right? That's why the whole city burned down. And we're seeing that there's vacant land. I know in Detroit, there's vacant land, in Cleveland and other areas. And we're seeing the same thing in Chicago and others, where you're actually starting to grow inside out, working with local food banks there to try to then not only bring in produce from outside of the city, but to grow some of the produce inside of the city. In order to do that, you need special individuals that are looking for the funding, right? And then we've got to help find those individuals that need the funding. And so we've got committed resources that are trying to do some of that here.
Excellent. Samantha, before I ask the question about programs to Raechel, you've got a response about minority farms or outreach to minorities?
Yes, we have two groups with whom we work in New England. One is the New Entry Sustainable Farming, and that is based in Lowell, Massachusetts. And that program matches people who want to farm, and many times they are recent immigrants with some land, and they have some incubator farms in Dracut and in other places where they work on a quarter acre to start, and the entity as a whole has a CSA. And so you can grow one crop or two crops on your quarter acre, and you contribute to that general CSA. And then the first year then is a quarter acre, the second year is a half acre on that starter incubator farm, and you can use resources, irrigation or equipment there. And then the third year of the program, they help you find land elsewhere so that you can grow your business and see, is this farming what you want to do? And then the other program is, and before I move on to the other one, when you go through that program, you get a certificate saying you've finished the New Entry Sustainable Harvest. And we have had at least one graduate become part of our Farm Start program. And so they have their own property now, and they are working with their own CSA based on the things they learned through that program. And he is an immigrant from Central America. And then the other program is something that is in Boston. It's called the Food Project. And that program is designed to help inner city kids learn how to farm and to produce food that they can be used in their food banks. And we support that mission through a variety of activities. So we want to get our name out there so that when they decide that they want to farm full time, they can come into our Farm Star or our other programs, and they know who we are and that we are there to help farmers.
Gary, there's a couple other things I'd just like to add, and those are great, Samantha. Congratulations to you and your communities and what you're helping with. Several years ago, maybe 3 years ago, another large farm credit and Compeer met with the presidents of the traditional Black colleges and actually worked very closely with them on aligning some of their students with agriculture, not necessarily to be farmers, but to help some of them to get into the ag industries. And they may want to be a productionist, but we want their skill sets in the food industry and in the distribution industry, et cetera. And so we were active in that and continue to have interest and work there. And then there's another segment of beginning farmers that are a little bit different than one might think, and that is beginning marketing and processing a product. And we find folks that have come from the Far East or even South America may have more skill in processing than growing, and will be processing or helping with distribution. And the farm credit system can do those kind of startups as well. And so we're seeing some of that occur. And again, our two officers that you mentioned are working with them. So they're not actually growing something, but they're helping to provide value and distribute it to other parts of the marketplace. And that's still part of the agricultural story. And it's something that Compeer Financial and other farm credits can lend into. So we find minority interest and activities there as well, Gary.
Yeah. And just to clarify, when we're talking about farm credit and minorities, it's an outreach to a group.
Correct.
Specifically, but there aren't, unlike FSA, as distinctly different from FSA, there are no set-asides or quotas or anything like that, because farm credit as a private institution is under the Equal Credit Opportunity Act. And so we can't use race, creed, national color, or national origin, or any of those things in a credit determination.
Bring the best ideas and let's make them happen. Exactly.
Yeah. So Raechel, what about partnering with other organizations to provide education or other services to beginning farmers in AgChoice?
Yeah, partnerships is really huge, and at AgChoice, we take it very seriously. We know we're not the only ones serving the agricultural marketplace. There are a lot of other ag organizations, government organizations. We mentioned FSA a couple times. Certainly, we utilize FSA guaranteed loans for beginning farmers. That's a real good product to use. But yeah, working with others is really important because we're all in the agricultural space together, right? And we all need to support the future of agriculture. And so we have taken a strong stance on partnerships. We've actually even created an educational program that is partnership based. So it's called AgBiz Masters, and it provides business and financial management education. And actually, we just finished up recruitment for the season that we held this winter, and we have another over 200 young and beginning farmers from the state of Pennsylvania, as well as Maryland, Delaware, and a few other neighboring states. So, and really that's possible because it's a network of about 25 of our organizations that are promoting that program. And so really, we all want to work in the best interest of agriculture. I want to tie into Terry's comment just there. We also do a lot with workforce development in the partnership space as well. So we're working with a lot of other ag organizations, not just to promote the opportunities in farming, which we certainly are doing, but everything else that food and agriculture touches, and frankly, the career opportunities that are available in those areas as well. So yeah, I would say, for anyone out there listening to this panel, in general, farm credit associations are very willing to partner with others with similar interests to ours. How can we expand our reach, especially in the education front?
Well, there's one big topic, last topic that I'd like you all to address, because I think it rolls in several of the questions that we've gotten from participants in the conference, and that is, will farming continue to attract new entrants? And Terry, what character traits and skills are those beginning farmers going to have in order to be successful in 10 or 20 years?
Very much need to be business focused, strategically focused, and stake out a value proposition that creates value both for them and the consumer or the marketplace that they're looking to serve. I believe commodity farmers over time have kind of lost the ear of the consumer that they're serving. And the new thinkers, the folks that are becoming wildly successful or will be entering into the marketplace, will be very focused on the demand for the product that they're delivering and the consumers who want or desire the product. And so I just think that there's a whole host of opportunities there. And the very, very smart individuals that will be entering the space will figure that out in spades. We're already seeing it. The experiments that we've talked about here today, and that's what they are. They're experiments. They're young entrepreneurs or middle-aged entrepreneurs that have taken a risk, and they're experimenting, and they're wildly successful when they match up and bring value in that form. And so we believe that's what will need to occur. They're going to need capital, but as things become smaller and more niche, you may not need as much capital as there is when you're trying to scale a commodity, because there's stickiness of value along the value chain that allows you to do it maybe a different way. And then they're also going to need to be very flexible and very creative in attacking the marketplace. And so those are, again, skills that any good business person would have if they were going to do a startup. And so we kind of see those kind of skill sets being very, very necessary. The outflow, I think the outside influence that we see from really large mega money from the tech industry and other arenas could be a challenge if they decide to scale, first letting the entrepreneur, the smaller folks work. But if the small folks can leverage technology in an effective way and it's still available, then we're very, very bullish on a whole host of new producers in the ag space. They'll just be doing it a little bit different.
Excellent. So Raechel, is it possible? Do you think farming can attract new entrants who can succeed, and what kind of character traits and skills do they need?
Yeah, most definitely. I feel agriculture is really full of opportunities. And if there's anything that we've learned from 2020 through the whole COVID experiences, agriculture is essential, right? It's here, it's going to stay here. Sure, farming in the future might not look like it did 20 years ago. That's okay, right? But farming is here, and we've especially seen in recent years the movement to local. Again, through this season, certainly that has even been heightened interest in local foods and the local movement too. But I think they need to be exactly what Terry described. So they need to be business minded. They need to be that entrepreneurial spirit. They need to take things and put the time and effort in as far as planning and having a strategic vision go. So all those things are really important, but boy, there are lots of opportunities out there for folks that want to get started.
I like that optimism. Samantha, we got just a couple minutes left. New entrants, can they do it? What do they need to know?
To build upon what Raechel and Terry said, what I find with new entrants is that they need to have a clear understanding of their market and how they're going to attack that market. They need to be able to provide a quality product consistently and be able to tell a good story so that the customers will learn about it, agree with it, like it, and then come back for more. So if you can market your product to the right customer, identify that customer so you know what to market, you can be a success.
And that was putting a great cherry on top of that whole Sunday of optimism. I see another question here that asks how many startup farms or young farmers have been funded in the last 24 months through Farm Credit. And we don't collect that specific information of startup versus beginning, but for a beginning farm, and remember all those slides that we started out this presentation with, we financed in 2019 67,080. That's a pretty exact number. Beginning farms, or beginning farmers across the country, and that was with a total of $14.3 billion, which is too big of a number to understand, but it works out to about $1.5 million per hour lent to a beginning farmer 24/7, 365 by Farm Credit. So if you haven't gotten your $1.5 million from Farm Credit yet, no, that's not what I'm saying. But we are officially out of time, and I would like to thank all of you for panelists, certainly, and for our audience for spending time with us this afternoon, talking about what beginning farmers need for credit and trying to get that down from the abstract level of the ag census to what actually happens at somebody's kitchen table with a loan officer. I want to point out that we've got another extension of this conference going on December 10th and 11th. It's called Training for Success, Resources and Tools for Working with Beginning Farmers and Ranchers. I think what we're trying to do is extend some of the expertise that Farm Credit has in training beginning farmers and ranchers, the education component of our mission, and sharing that with others, bringing other new tools from folks who are experienced in training beginning farmers and showcasing them also. So we would really like you to save this date. The website is up for you to look at the draft agenda of that meeting. We haven't started registration yet through Farm Foundation, but you'll be getting an email since you were part of this conference. So please look forward to that follow-up conference. And Jeff, I think I'll toss this back to you for the ending of this conference. Thank you very much for allowing us to be part of it. Jeff, you were muted, I think. There you go.
Great. Thank you, Gary, and thanks to everybody who participated in the conference. I'm delighted to have all of our discussion. I'd just like to mention that throughout the conference, we held a number of sessions on agricultural credit, also on land access, alternative markets, and this morning, transitions. All of our presentations and even video from the presentations is going to be available on the website you're on now, and will eventually transition to YouTube. And I'd also encourage people to go to the USDA networking booths. If you would like to, if you haven't already, there's a number of materials that are available there. It's a collection of a lot of different USDA programs and information from research agencies on beginning farmers and ranchers. So that resource is going to be available. We're also going to have the lounge open for the next hour, and you know, I've had a couple of great conversations there with people that are working on you know, in a variety of situations, and I've benefited quite a bit from those, and I'm grateful for them. For the research presentations that were made yesterday and today, we are going to be putting those through peer review through an academic journal, Agricultural Finance Review. So you'll be able to eventually see these in print and share those findings, give them a permanent home as well. Before I sign off, I do want to thank Farm Foundation. They've been a pleasure to work with throughout this process. Morgan Craven and Martha have been just a delight to put this together. And despite all my best efforts to sabotage it at every moment with the echo, and I think I took us live this morning. I mean, it was pretty much everything I could think of. I did rattle them. They were unrattleable. Anyway, thank you very much, and hope to stay in touch. Remember that USDA Economic Research Service is interested in studying all of these issues that have been discussed, and we're going to keep at it, and I hope you guys do as well.